Jeff Fowler with the Apartment Owners Association. It's great to have you with us today. And yesterday, first of all, I do want to say that we have closed caption on Facebook, so you could head over to Facebook if you want the closed captions. And anyway, just want to say yesterday was Tuesday, and many of you caught the pun and you followed along with us. And what we did is a lot of us called in to our county supervisors and our city council members, and we gave them feedback on what we think about the emergency orders continually being extended. So Alameda County, LA County, LA City, and other places as well, just really continuing this thing. It's really a farce, and it's just a way for them to grab power. And so we really shifted our messaging from why it's hurting us as housing providers to why it's hurting tenants, why it's bad for them. And so I do have a video that I put together, and also an article, so you can get those if you look at our YouTube, AOA USA. It's the Tuesday deal. And anyway, just to say thank you to those that did get involved. And if you didn't, guys, this is a grassroots movement. We need everybody to call. And even if you live in a county or a place where you're only under state rent control, calling your local officials and saying, hey, thank you. John Lee, he's my city council member, and so I was able to call and say, hey, thank you, John Lee, for voting against the extension of the emergency orders every single time. And so anyway, just you got to stay connected, and we got to fight this thing together, because what they're going to be doing, even April 1st, it's just ridiculous. Call today, send that email out. And even if it's a day late's better than never. And we just have to take action. You don't want to be passive. You want to be a person that takes massive action. That's one of the keys to success in Dan Fowler's success seminar that he does. So this is day 720 of the hostage crisis. They've been holding some of us hostage as housing providers, forcing us to fix things for tenants that aren't paying rent, forcing people to be housed illegally, and so much more. And so we want to continue to fight against it. And we do have a political agenda for sure, but really what we really are focused on more than anything is your success. And so we're doing everything we can to generate ideas for you and show you ways that you can be successful as a housing provider. And we do have the tenant screening, and just want to mention that no one does what we do with the eviction reports. We actually use 2 different companies, and they overlap a lot, but both of those companies find things that the other company doesn't find. And so you have a very comprehensive report with that. Credit reports are pretty much the same everywhere, but we do add a few ID verification things in there that maybe not everybody does. So when you look at the report, you'll be like, wow, there's actually a lot to this. And the criminal reports, we call it the 3-in-1, because you get a social security trace, and I'm gonna double check their social security number, make sure it hasn't been used by someone who's deceased, and it gives you a previous address history list besides having the criminal report. And so all those things come with a criminal. So all the stuff that I'm talking about you could get for $16.95, which is just an incredible deal. And so you'll want to sign up for that. You do need a site inspection, but that site inspection, they just want to see your place, your office, where you have a shredder, where you have a password-protected computer, where you have a filing cabinet. If you can show them those things, you'll be able to pass the site inspection. The site inspection is even virtual, so more and more things are getting easier. And anyway, so save some money by getting the site inspection and using the AOA tenant screening for sure. And also just want to mention, these are things for members. These are member benefits, so maximize your membership. The other thing is debt reporting, and it's $12.95 to report somebody's debt, they are taking COVID rent debt that is being reported, and so we're working with a collection agency / attorney's office, and so they are reporting those things. We need to hold people accountable. That's one way that you can do it. Even like the officials are saying, it's not that they don't have to pay rent; they just don't have to pay it right now. Well, when people leave, those things become due in the right circumstances and everything. So definitely you can call in and ask about debt reporting and see if it's time yet for you to be able to do that. All right, so a whole lot there. At noon we have the topic is self-storage. Right now we're going to give you the top tax secrets for 2022, and so that'll be great. If you're watching on AOAUSA.com, there's a blue help button, and you can put questions in there, and we'll be able to answer those for you. So this event today, it's sponsored by Robert Hall and Associates, and they are tax preparers. They have been around for almost 50 years, and they have over 500 5-star reviews, which is tremendous. And so they're going to be able to find things most likely that you may not be able to find in your taxes and help you save a little money. So they're definitely worth it. And our speaker today, he is a partner, or let me see. Okay, yeah. So senior tax consultant, and he's an enrolled agent, means he's federally licensed to do what he's doing. 17 plus years, and he goes around on a circuit speaking for Robert Hall and Associates. He's been given Glendale's Reader's Choice Award as the best tax preparer. There's a mouthful. And so it's my pleasure to introduce you today, Tony Watson.
Good morning, everyone. Thank you so much, Jeff. Thank you so much, everyone at AOA, for having me back. I love coming here to speak with AOA and all of its members. It's always great to have discussions with like-minded individuals, with real estate investors who are on the same path together to build wealth in real estate and to make sure that as you are building that wealth, that you are keeping as much of it in your own pocket as possible. Today's topic, how to protect your wealth to keep more of what's yours. That's really the name of the game, folks, is every single year, obviously nobody likes to deal with taxes except for me because I get paid to deal with taxes, but nobody really likes to plan ahead when it comes to taxes. It stresses them out. It keeps them up at night. Obviously, that's never a good thing, right? So you want to make sure that you understand a little bit more about the tax industry rather than just thinking of it as a pain to put things together. You need to make sure that as you gather your information, the eventual goal, yes, for you is to reduce liability, but in the end, it's to retain wealth. Right? The more tax you save, the more you get to keep. And so as you progress in the real estate industry and investing and building business, just understand that a big part of your business is the income tax world and filing on a year-to-year basis. So always keep that in mind. So how to protect your wealth to keep more of what's yours, asset and wealth protection for the future. Let's face it, we are in a very interesting time of all of our lives with a war on the horizon, with the economic, somewhat of a little recession because of the pandemic, with the eviction moratorium. I mean, we've got a whole lot of things going on, which just adds on to our plate of stress. So this isn't something that's incredibly important to look for and to plan for in 2022 and as we move forward into these kind of uncertain times in 2022. Hopefully we come out of this mess unscathed, and that we that we end this 2022 year in a better place than we were 2 years ago. But we'll have to wait and see. Just make sure that you're out there supporting each other and making sure you're keeping everyone safe and also holding people accountable. You know, your renters, they should be accountable for paying that rent. So I very much am appreciative of Jeff and everybody here at AOA when they talk about kind of the what's going on in the real estate market right now and how people are just avoiding paying rent, even though, I mean, I see it on their tax returns too. I see that people are still making money. So yeah, we have to hold people accountable to what they owe you for your investment, the investments that you've worked your whole life to obtain and now provide housing for other individuals. So Myself, with Robert Hall and Associates, I've been with the firm for 17 plus years. I am not only an enrolled agent preparing taxes. I think now I actually have clients in all 50 states. Our firm, I know we have clients in all 50 states. So as a federally licensed enrolled agent, I am licensed to prepare taxes on the federal side and in all 50 states across the U.S. I very much practice what I preach, though. So as the public speaker for the firm, I do travel around and I do seminar circuits all the way from San Diego to Northern California, sometimes even being asked to exit out of California for a day or two to speak in other states. So, I very much am a practicing what I preach kind of investor. Not only am I a tax advisor, I am also a real estate investor. So I implement strategies on my clients' returns, and we as Robert Hall and Associates, we implement strategies on our clients' returns because most of us are real estate investors ourselves and small business owners. So very much practicing what we preach. Just in my clientele roster alone, I think my clients are currently managing, wholesaling, flipping, commissioning deals in the $350 plus million range. As a firm, as a whole, I think we're well into the $1 billion marker. I would assume that we're well above that by now. And so we see a lot at our firm, specifically and especially in the real estate industry as well as the self-employed small business industries. We've won a couple of awards in the Southern California area, but you can read more about us online, roberthalltaxes.com. Only one office in Glendale, California, but once again servicing all 50 states and tax filings. We offer a number of services, obviously tax preparation, we incorporate businesses, we do internal auditing, financial planning. We're kind of a one-stop shop for all of your financial needs. So once again, you can check our services out online. And we do offer free consultations, which I will remind you about towards the end of today's webinar, but I do want to jump right into the meat and potatoes today. So let's talk really quickly about asset protection and asset separation, because I've been getting a lot of calls, a lot of questions, a lot of emails about what entity would be right at any given time for my specific clients. As a real estate investor, you want to make sure that not only do you get the asset protection benefit, but if there is a tax benefit, an income tax benefit to be received, you also want the best of both worlds, right? You want the asset protection and the income tax sheltering. Well, understand that with rental income, we have to kind of look at each individual revenue stream and break it down based on what revenue you're bringing in. Rental income versus self-employed income versus W-2 income versus retirement and what's called unearned income, which would be Social Security, IRA distributions, 401k distributions, so on and so forth. So we have to look at the revenue stream first and figure out what types of tax those revenue streams pay on a year-to-year basis. And that will help us determine whether or not an LLC, a C corporation, or an S corporation would be right for you specifically. Remember, just because your neighbor, your coworker, a family member incorporated themselves as an LLC, that might not be the right entity for you. Or just because they set up an S corporation and it saved them a whole lot of money doesn't necessarily mean that you should go out and set up your own S corporation. You have to look at your own specific and unique situation and have conversations with tax advisors about how you should establish yourself under an entity such as an LLC, C corporation, or S corporation. So rental income is very unique. The rental cash flow from your properties will only ever pay federal and state income tax. Your rental income will never have to pay Social Security and Medicare tax. Unlike property management income or even self-employed real estate commission income, which every year pays federal, state, and self-employment tax. So that's a really key part of the different taxation or the different taxability of self-employed income versus rental income. Now, LLCs, which we're going to talk about really quickly first, right out the gate, LLCs are only for liability protection. They save you absolutely nothing in income tax. In fact, the LLC does exactly what its name entails. It limits liability. The LLC stands for Limited Liability Company, not Limited Liability Corporation, because an LLC is not a corporation. It does file articles with the state of California, but it does not file articles of incorporation. It files articles of organization. So you are organizing your information with the state of California, not incorporating and issuing shares, unlike the S Corp and the C Corp. So the LLC is great for liability protection, but saves you absolutely nothing in income tax. Remember that when you're signing lease agreements or contracts or anything on the legal side, where if you tell somebody that you are a corporation or that you are incorporated and you have shares of a business, understand that if you are an LLC, you don't actually own shares of a business and you could be in breach of malpractice. Okay, so the LLC does exactly what its name entails. It creates great liability protection, saves you nothing in income tax. So what you are trying to achieve under an LLC filing is great asset protection on large depreciable assets. But before we actually incorporate anyone or start an LLC or an S Corp or a C Corporation, before we get into that kind of down the road conversation, we need to figure out if incorporating is even right for you. Right? Because incorporating, I'll tell you right now, folks, is not right for everyone. The 3 questions that I like to ask my clients in order to establish a reason for incorporating is, number 1, what personal assets do you own? Personally, not business assets, but what personal assets do you own? Because the number 1 benefit of incorporating is asset separation and asset protection. So asset separation equals asset protection and vice versa. So we want to make sure that you have assets that need protecting. First and foremost, if you don't own personal assets, if you don't own a primary residence, if you have no retirement accounts, if you have no other personal assets, a fine art collection or a classic car collection, well, I mean, incorporating your business and separating the property from you personally, it would really be more for protecting the business asset at that point, not separating it from any personal liabilities or personal assets that you have. So if you say that, yes, I do own a personal home, I do own a 401k or an IRA, I do have personal assets, okay, we check yes to box 1. Question 2 would be, what kind of profit are you going to be looking at consistently over the next 2 years? Well, if you've been in business for a while, it's very easy to look back at previous year's tax returns and kind of dial in your annual net revenue. And if you are sitting at about $45,000 to $50,000 in net revenue per year, for a self-employed individual, an S corporation might be the best route for you, because you are hitting stride with that net revenue at a certain level of income, $45,000 to $50,000, and that would warrant a benefit under the incorporated entity, or not warrant a benefit, but it would actually spark the conversation of incorporating possibly for tax savings benefit, which we'll get into in a second. But question 2 is about net revenue. If you say that my net revenue is not really there yet, but I do have a personal asset, okay, we would be incorporating solely for the asset protection benefit. If we get to question 3, which is more about risk and liability, it's really trying to establish what risk you operate at or what level of risk you operate at in your industry. Let's face it, as a real estate investor, you're not going to have the same risk levels as a skydiving instructing business, right? Or a flight instructing business, or a driving service of some sort, right? Those businesses tend to have a much higher risk and liability, kind of industry over industry compared to real estate. And so some individuals, whether the income or profit is there, whether they own personal assets or not, they might incorporate solely for the asset protection benefit moving forward into future years. I think that these are probably the 3 most important questions to ask a client. I call it the interview process. And as long as we check off all of the boxes, taking the next step to incorporate would give you an asset protection benefit, but whether or not it's going to save you tax is a different story. So if LLCs are only there to limit liability, which entities are there to actually give you asset protection and tax savings? Well, remember that if rental income only ever pays federal and state income tax and does not pay self-employment tax, you would actually just put the property under an LLC for greater liability protection, because there's really no way to save you tax on the federal and the state side. Where an incorporated entity comes into play to save you tax is on the self-employed side of things. So for the property managers listening in today, for the realtors who are selling property for commission income, you might want the LLC for great liability protection, but you'll want to tax yourself as an S corporation, a subchapter S corporation. The S corporation, out of all 3 entity structures, is the only known entity to actually reduce overall income tax liability for taxpayers. Now, it's not going to reduce federal and state income tax, because it doesn't matter how you split your profit, whether it's a 40 grand W-2 and a 60 grand profit through the business, or a 50 grand W-2, 50 grand profit. When you add those numbers back up, it's going to equal whatever your net revenue is. So you'll pay federal and state income tax on the full profit, no matter what, whether you're an LLC, an S Corp, or a C Corporation. But under an S corporation, you can actually divide that profit into two different numbers, making only one figure subject to self-employment tax and the other income figure only subject to federal and state income tax. So once again, have this conversation with your tax advisor. Don't try to navigate the rough waters of the incorporating conversation by yourself. This is something that a licensed tax advisor should absolutely be able to advise you on, not from a legal perspective, but just to talk to you quickly about and efficiently about the tax benefits of incorporating as a specific type of entity, and also based on what assets you own. So rental properties, LLCs, probably the most popular entity for rental investments. And if you are a property manager or a self-employed real estate professional, an S corporation or possibly even a C corporation might be the correct entity for you. But once again, I don't think that I have enough hours in the day to go over every single scenario. So obviously during the Q&A session, if you need any clarification on any of what we just discussed, go ahead and type your questions in and we'll get to those questions shortly. Asset protection has been a pretty popular thing over the past 2 years, as you can imagine, with people not really losing things left and right, but just fearing what the future has in store for them, making sure that they're set up to where if anything happens to them, if they catch COVID and heaven forbid they pass away, they want to make sure that not only are their assets protected from a litigation standpoint, but also maybe the assets need to be put into a living trust so that if heaven forbid anything happens to them, the state of California cannot seize those assets and hold them in probate. So a very important topic these days, asset protection as well as estate and trust planning. Now, as far as deductions are concerned, moving into 2022, I find that one very popular conversation for my real estate investors is the topic of cost segregation. Now, some of you out there might have heard of cost segregation before. You might kind of understand the concept of it, but is it a good thing for you? What type of deductions does it create for you on the personal side of things for 2021 and 2022? Cost segregation, the best way I can define or explain cost segregation is the ability to reach into future years and capture future year depreciation deductions to take them all in this calendar year. So imagine this, if you are showing incredible profit through your real estate investment properties and you're thinking, well, I've already deducted the mortgage interest, the improvements, the property taxes, the insurance, and you're still showing a high net revenue and you're calculating the tax and you're figuring, oh my gosh, I have to pay all of this money to Uncle Sam in the state of California. What else can I do? Are there any other things that I can deduct without having to go out and spend hundreds of thousands of dollars improving the property because I've already done that, right? So cost segregation is not an immediate out-of-pocket expense. Sure, you pay some money for the analysis to be done, but what this cost segregation analysis is doing is it's reaching forward into future years and capturing future depreciation and accelerating it all in this year to increase cash flow and reduce overall paper net profit. So you're taking deductions from future years, and hopefully with all of that cash flow that you have now, because you're not paying tax on all of your profit through the cost seg analysis, hopefully you're taking that profit and you're buying more real estate, restarting depreciation on the new property, maybe acquiring more debt, having more improvements, and allowing those deductions to consolidate and offset your other positive cash flow rental investments. So cost segregation has become incredibly popular over the past 3, 4, 5 months compared to the past 10 years, I'd say. Just this week, I think I filed returns, probably 3 or 4 returns with cost seg analysis work done or elections done, and that's just this week. And that's unheard of in our industry, in my opinion at least. I don't normally see 3 or 4 filings in one specific week. So some of you might be thinking, well, Tony, depreciation is a great write-off, but if I ever sell that property, don't I have to recapture the depreciation in future years when I sell it? Well, absolutely. Depreciation is something that is a great benefit while you own the property, but if you ever outright sell the property and do not exercise a 1031 exchange, and you just want out of the real estate investment, you want to cash out and maybe use that money to travel or to pay off student loan debt, or maybe start a business with a family member, whatever you're doing with it, if you're accessing the cash out of that sale, the federal government will not only hit you with capital gain tax on all of the appreciated value, but all of the years of depreciation write-off you've taken, you have to recapture that, add it back onto your return as income, and pay ordinary income tax on that dollar amount. So some of you might be thinking, well, why would I want to do that? I don't want to recapture depreciation. That just seems like an added income tax. Well, remember, at least the goal for me as a real estate investor is to kick the can down the road until I kick the can. right? It's to 1031 exchange properties until I truly kick the can, until I leave this earth, because the benefit under the current Internal Revenue Code, if I pass away, is not for me, because I'm dead. The benefit is then for my beneficiaries. Because at the moment, the stepped up basis ruling leaves up to $12 million in assets per spouse for next of kin or for surviving spouse tax free. Meaning that if I bought my properties for $600,000 and now they're worth $5 million after years and years of exchanging property and acquiring more real estate, now I've got $5 or $6 million in real estate. Well, that's under the $12 million estate exemption. So my heirs receive all of my properties with stepped up basis amounts, meaning that they no longer are taking the $500,000-$600,000 basis, which was my basis while I was alive. Now that I'm dead, they actually inherit the property with a $5 to $6 million basis. I'm being very general with my calculations here, by the way. There's a little bit more detail in all of that. It's not that easy, but you kind of get the concept here. Is that the benefit is not for you in a 1031 exchange. The benefit is kicking the can down the road, allowing you to diversify your investments, obviously, but the income tax benefit really goes to your surviving spouse or your next of kin. Now, the federal government is talking about adjusting the estate exemption. In fact, they were discussing getting rid of it altogether, but allowing individuals to take suspended losses upon death. That has not been finalized. That has just been a topic of conversation, and as you can imagine, with the federal government being close to $24 million documents behind in processing, I mean, we're seeing massive backup in the pipeline, the sludge that's backed up in the pipeline with the IRS right now. Just to give as a side note, last year they were 8 to 9 million documents behind in processing. Now, currently, as of about 2 weeks ago, they quote 24 million documents behind in processing. So they've taken a lot of agents out of other divisions with the IRS and allocated them to kind of push through paper filing and correspondence returns at the IRS level. So we're seeing a lot of the IRS playing catch up these days. But, you know, with that topic at hand, you know, with everything that's going on with the war in Ukraine and Russia and everything that's going on in the world on top of a pandemic, we're seeing people really taking a stronghold of their financial situation, doing some planning, you know, and making sure that if this new tax code does pass, the way that the Green Book is stated at the moment, where they get rid of the estate exemption and allow other benefits, but really not the same benefits as what we have currently. They are trying to move assets around to make sure that they're not being hit by such a significant tax implication under the new Internal Revenue Code, which has not been passed yet. You know, Jeff and I were just talking when I walked in the room, and he asked me, so what updates do we have today? And I said, well, with the government being at a complete disarray, in complete disarray, and with us going to war, there really is nothing finalized under the Green Book yet. We know that the standard deduction will change. We know that capital gain rates will more likely than not change. We know that certain brackets will change due to, you know, just economic inflation or deflation. So we know that certain things will change, but as far as cost segregation is concerned, we haven't heard any topic about getting rid of that. So I know for a fact that we'll be able to take advantage of this. Depreciation on car deductions, that will still stick around. There will be still the 26% solar tax credit around, you know, but as far as the topic of the 1031 exchange, which we'll talk about next, and some other parts of that Green Book, nothing has been finalized. I think that the government's pretty busy right now trying to wrap up the tail end, hopefully the tail end of this very long 2-year dark tunnel that we've all been driving through called the pandemic. So cost segregation is something that we absolutely need to focus on in order to increase cash flow. Even though you might have to recapture the depreciation years down, you know, years later in future years, understand that the benefit here is to increase your cash flow by taking this phantom expense. See, depreciation, in my opinion, even though it is recaptured, it is one of the greatest deductions for real estate investors in the immediate present, because it is a deduction that you're not paying for, right? Yet, at least. You're actually getting this phantom write-off. It's called a phantom expense. That's what I call it, at least. Depreciation is not something you're coming out of pocket and spending money for. It's the value of your building spread out over 27 and a half years for residential and 39 years for commercial. And so the government allows you to take this deduction based on the value of your property or the basis of your property, including some improvements that need to be depreciated, and allows that as a full dollar for dollar write-off, whatever that dollar amount is, to help reduce cash flow and pay less income tax. So why not take future depreciation? If you're never planning on selling your properties, if you want to leave your real estate wealth for your next of kin, continue to do 1031 exchanges, kicking that can down the road until you kick the can, and keeping a lot of this cash flow and just buying more real estate. That's the whole benefit with cost seg. Now, it's not something that you can do. It's not something that myself or any of the accountants at Robert Hall can do. There are third-party companies that you hire to file this cost segregation analysis. In fact, I had a client the other day say that they went online and the analysis that they applied for was free. Now, the actual filing or the finalization of the cost seg analysis would have to be paid for, but you can actually get free cost seg analysis done online. And so just make sure that you check that out and see what you could potentially qualify for as far as accelerated depreciation is concerned. Now, let's talk really quickly, because I feel like maybe I went a little bit quickly on the incorporation side of things. I did want to mention that some of you might be thinking, because I have a great insurance policy, I don't need an LLC, I don't need an S corporation, I don't even need a trust because I have great insurance. Well, understand that as you look at this screen and you see these 3 doors in front of you, each door, when you open it, leads you down a different path, right? It provides a completely separate benefit and outcome for you as a business owner. The insurance policy is by far the most important thing for us to have. We have car insurance in case we wreck our cars. We have health insurance in case we get sick. We have, malpractice insurance in case we get sued. So insurance is absolutely the most important thing for us all to have. It is there and in place to pay out settlements in case an unforeseen event happens. It actually has a dollar value at the end of the day. But what an insurance policy does not do is it does not separate business and personal assets. What the LLC and the S Corp and the C Corporation do is allow you to separate business from personal assets that you've obtained over the course of your lifetime by assigning those businesses and those properties their own identification numbers. See, one thing that we all have in common is an identification number. That is a social security number. Our tax returns will look nothing alike, right? If we lined up 100 tax returns for everybody who's sitting in the audience today and we lined them all up next to each other, there isn't a single tax return that will look the same. We all have different write-offs. We all have different elections. We all make different elections. We all have different credits. Some of us might have children. Some of us might have spouses. Some of us might be single or head of household where it's a single parent with dependents. So everyone's tax return will look different. But one thing that we do have in common is an identification number, and that's what makes an LLC and an S Corp and a C Corporation unique, is that when you incorporate your rental property as an LLC, you are assigning that property its own identification number. So in theory, if somebody sues Tony Watson, they're not suing my name normally, they're suing my social security number and everything that is attached to my social security number. Sure, on the paperwork it says Tony Watson, but what they're really trying to come after is my personal wealth, my personal assets. And so if they sue me individually, they're not necessarily coming after the assets that are not owned by me personally anymore, but the assets that are owned by the LLC or the S Corp or the C Corporation, and vice versa. If somebody sues the entity, they're not coming after me personally. So some of you might be thinking, well, Tony, I've heard that people can get sued personally and on the business side. Absolutely. It takes time, it takes money, it takes great legal representation, and it takes proof. Evidence in a court of law by, normally filing a charging order, filing it based on illegal activity, malpractice, negligence, or just straight up ignorance. They can sue you with evidence in a court of law. But once again, it takes time, it takes money, it takes great legal representation. So having that added corporate veil, I know we've all heard that term before, absolutely gives you some peace of mind that your assets will be protected separately from all of the personal liabilities and assets that you might have and own. So insurance is there to pay out settlements in case an unforeseen event happens. LLCs, S Corps, and C Corps are there to separate business and personal assets. So where does the trust fit in? Well, unfortunately, one major life event has to happen in order for us to see the most benefit out of a trust. And that life event is death, right? The trust is really not meant to protect you while you are still alive. It's meant to protect your assets in death. So that, heaven forbid, something does happen and you leave this earth and go on to something bigger and better, your assets aren't catapulted into a little piggy bank held by the state of California, where California holds those assets and gets their sticky fingers all over them. The trust allows us to transition those assets to your next of kin, your surviving spouse, your favorite charitable organization, whoever you're leaving your assets to, and it avoids probate. That is the main benefit of a living trust and most other trusts, irrevocable, revocable, and even some estates. Now, just because you have a will Okay, and I'm not an estate attorney, so I'm not giving legal advice, but I do know just because you have a will doesn't mean that you are protected in death. A will is more of a directive of assets. It's just kind of like a final say in what you would like to happen with your assets. So normally a will is attached to a trust or an estate, but once again, have these conversations with your estate and trust attorneys, and they'll make sure that you are set up correctly in case, heaven forbid, anything happens to you. We've seen a lot of that over the past 2 years. A lot of death, a lot of despair. It's been a wild ride over the last 2 years. I told my client the other day, I said, my job has become very bipolar. Not me, I'm not bipolar, but my job has become very bipolar. I talk to, close to 10, 11 people a day, Monday through Saturday. And starting in 2020, it was all laughs and jokes and things at the beginning of the year. And then all of a sudden, when COVID hit, it started to turn a little bit. And so every other conversation is something different. I've heard success stories. I've heard sad stories about families losing loved ones. I've heard, some kind of consistency in some clients' files. And, I'll tell you, I can't wait till we're out of this thing because I want to get back to whatever the new norm is going to be, obviously. But these are conversations that I have almost on an hourly basis, making sure that the insurance policies are titled and set up correctly, making sure that the LLCs are there if they are needed, and the S Corps and the C corporations to help retain wealth and not overspend with the federal government and the state of California. And more importantly, now that families are having children. I just introduced my new baby daughter into the world 8 months ago. And so naturally, I had to update my living trust. I had to make sure that everything was in place just in case, heaven forbid, anything happened to me or my wife. So we saw a lot of birth. Along with a lot of death, unfortunately, in 2020 and 2021, but we saw a lot of new life. And so these were very important and prevalent conversations, more so than ever over the last 2 years. So just make sure that you understand the difference between these three things. They provide completely separate benefits from one another. So insurance, by far the most important thing. LLCs, S Corps, C Corps, maybe, but a trust, if you have next of kin, if you have valued assets, you absolutely want all three of these things established for you as a business owner and investor. Now, Section 1031 of the Internal Revenue Code. I wish that I was coming back to you with a final Internal Revenue Code, something that was literally posted on the irs.gov website. But unfortunately, all we hear are chat rooms talking about if the 1031 exchange isn't going to pass the new rules or if it is going to pass. And the way that the Green Book is written is the federal government would like to limit the overall deferral of gain to $500,000 per taxpayer. Now, once again, I've read articles online saying that this conversation has been tabled, but I go off the IRS website, right? I have to go to irs.gov and I have to see it written in Internal Revenue Code to know for a fact that it is not on the table anymore, and we have not seen that yet. It has not actually been posted to the irs.gov website, or at least I haven't found it, and I look at the IRS website almost on a daily basis. So Section 1031 of the Internal Revenue Code is probably one of the oldest real estate tax codes that we have under current IRC. It's over 100 years old. And the federal government, after 100 plus years, is trying to establish new basis in this Section 1031 part of the IRC, which they are trying to limit, once again, the gain to $500,000 per taxpayer. So married filing joint, $1 million deferral of gain. And the single individual, $500,000. At the moment, there is no limit. So if I have a Burbank shopping center that I bought for $600,000 35, 40 years ago, and now it's worth $5 million, and I don't want to own that shopping center anymore, I want to own 20 units elsewhere in the U.S., the code at the moment allows me to defer all of the tax liability on the appreciated gain as long as I am exchanging that property for like-kind investments. It can be commercial for residential, residential for commercial, commercial for commercial, residential for residential. It cannot be U.S. property for foreign property. It cannot be foreign property for U.S. property. So understand the rules here. There's a 45-day identification period, and including the 45 days, you have 180 days to fully close on the transaction. If your property that you are trying to exchange into is in a federally declared disaster zone, then there might be an extension on that 180 days, but it's very rare. Okay, so just understand that the government is trying to change this at the moment. Nothing has been finalized. And once again, we have to go off what is set in stone on the IRS website and part of the Internal Revenue Code, which it has not been yet. So we still have a chance of this not actually passing. Which would be terrible. limiting all of that gain and now paying tax on the above and beyond dollar amount, which then bumps your income bracket higher, possibly making your long-term capital gain subject to not 15 or 20% anymore. But if another part of the Green Book passes, you might be subject to 40%, 39.6% to be exact, but 40% federal capital gain tax on every dollar above 500 grand or $1 million. Once again, there's a little bit more detail in that and calculations that are involved, but these are all great conversations to have with your tax advisors and to make sure that you're planning ahead for all of these significant changes. Once again, what's been passed into law? Nothing as of today. We know that the standard deduction will change. Once again, it'll increase by about, what, a grand or so, 500 to a grand. I forget the exact dollar amount. So we know that that changes. That's always been built in as part of the inflation, part of the Internal Revenue Code. So we know that. We know capital gain rates are going to change. Net investment tax is going to stick around. We know that certain credits are going to be available. But the major things that we are concerned with as real estate investors, they just have not been finalized yet. So I'm really, really intrigued and interested to hear about what the government does coming out of this pandemic to help the taxpayer. Because, right, they printed, what, how many trillions of dollars in 2020 and 2021? That money's going to have to be paid back. I noted at some point somebody said, I forget who it was, but somebody said the U.S. taxpayer will not have to pay back this money. Well, sure, we don't have to pay it back, but the government's going to collect that from us in one way or another. It's simple economics, folks. It is something that if you understand how the economy works, how U.S. economics works, there's no way that the federal government won't increase taxes to collect back this money. It's just impossible. So we'll have to wait and see what the final code settles as. Once again, I did want to mention before we get into Q&A, we do offer free consultations. All you'll need to do is text Robert Hall to the number 72000 or open your smartphone camera and scan that QR code at the bottom right hand of the screen. If anything, if you're very happy with your current tax advisor, maybe a second set of eyes on the return just to see if anything could be changed or anything could be corrected in previous years. But more importantly, to put you on our email update list for our upcoming free webinars. All of our education at Robert Hall is free. I am the keynote speaker, so it'll only be my face on the webinar, but as soon as we have this new Internal Revenue Code set in stone, I'll take about 24 to 48 hours to learn as much as I possibly can. I already know a lot of what's going to change, standard deduction, capital gain rates, and whatnot, but as soon as we have the final code on the real estate side, real estate professional elections, exchanges, accelerated depreciation, recapture rules, and also income thresholds, I'm going to be right back with an updated PowerPoint presentation, and we'll hit the ground running with probably 3 or 4 webinars a week. So if anything, if you don't want the free consultation, sign up so that you know about our upcoming free webinar events. So that's it from me, Jeff. We're going to open up for Q&A, I guess. Yeah.
All right. Well, great. Thank you so much for sharing. And some of you may have jumped on late, and I love this. Heinrich on YouTube, he said, I made my calls and was told that they have been receiving lots of calls. So, man, that's awesome. Thank you for that little feedback. I did get a couple different emails from some of the offices here for city council members and a county supervisor office. So anyway, all that to say that we're doing something, we're trying new things, and if we don't succeed, we can always keep trying. We can always try different things, and just love just the thing of never giving up, never giving in, and just continuing to stand for what's right, because it's not right. What they're doing to apartment owners is not right. So if you didn't get a chance to participate with us yesterday, you can still do it. A day late is better than never, right? And right, so type in your questions now, and if you've already started your taxes, you might have a question on how do I file it? Where do I put this one specific thing? You can ask any question you want regarding taxes. If you ask a question about can I evict, Tony's not going to be able to answer that one for you. But let's go ahead and get started with Sam. Excuse me, itchy nose here. Sam, how can I get this how can you get this cost seg available free online? How do I get a hold of people? Any phone numbers? And so I want to say yes. We did a live stream. It's called How to Make Your Apartment a Tax Saving Machine. How to Make Your Apartment a Tax Saving Machine. If you type that in along with AOA USA, that'll come up. And the company that did it is BDO and a guy named Jeff Hobbs there. And they're just quality people. they have one of the special reports that we give to people when they join AOA that he created a special report for us and a special deal for AOA members. Of course, that first part is free, but then there's an additional benefit for AOA members, and so that was a big deal about a year ago when he did that. And anyway, so Sam, I hope that helps you. So look that one up, and his phone number and everything it's at the bottom of that video when you click on the more part, so you'll be able to get that. Okay, Cheryl Ann on YouTube. How does a property in an LLC transfer to an heir after you pass as opposed to a property in a trust?
Sure. So the LLC is, once again, only for greater asset protection, but it still is a capital asset that is owned by you individually. If you are in or have an established living trust, while you are still alive, your trust is still registered to your primary Social Security number. So all assets held within an LLC, and if the ownership is your living trust, everything is still connected to your primary social. So all of those capital assets, everything outside of 401ks, IRAs, and deferral retirement accounts would receive that full stepped-up basis under current Internal Revenue Code. So it doesn't matter if the property is held under an LLC or if it's held under a living trust, all of those capital assets receive the full stepped-up basis. Now we're talking about income tax, right? As far as property taxes are concerned, that's a whole other world of the tax realm. So you'd probably want to make sure that no reassessments were going to get hit, obviously with Prop 19 and changes there. You'd want to check with the county assessor's office about transfer of property and the reassessment of property tax base. But from an income tax perspective, whether the capital asset is owned personally through an LLC or through a living trust, it would all receive stepped-up basis benefit for the heirs or surviving spouse.
Great. All right. If a realtor makes about 100 to 120K net income per year, is an S Corp or LLC better? The owner is the only employee. Thanks.
Great question, and that is a perfect example of who actually should be incorporated. I'd say that $45,000 to $50,000 net profit is the threshold where I actually open up the conversation for incorporating. As a real estate professional, as a realtor, the most beneficial structure happens to be the LLC taxed as an S corporation. If you want to just go straight up S corporation, you can get that. You can incorporate that way as well. I like having the best of both worlds, though. The LLC for limited liability protection purposes on the state side, but then electing for the LLC to be taxed as a subchapter S corporation. Now, I know that that is the greatest income tax structure for you, but as far as the greatest legal structure for you, you might want to also have a conversation with an attorney. An attorney might see something in your asset portfolio or in your personal world that might suggest for you to be better set up as a C corporation or straight up as an S corporation without the LLC. So we very much are open to having conversation with legal advisors and making sure that you are legally protected first, and then figuring out ways to convert your entity for tax benefit purposes. But the LLC taxes the S corporation. That is the most popular entity structure for real estate professionals.
Great. Okay, Lauren here. I came in late. We're waiting for the question here. I'll ask a different one. Now, can you tell me where do we put, how do we deal with security deposits? Is that an income, or are we supposed to input that as an income, or how do you deal with that?
Sure. So a lot of clients in past years have assumed that when you collect a security deposit that it should be income, but it's not income. It's actually an asset of your business. And so you do not, when I collect a $2,000 security deposit, I do not include that as income. What I do is I report it as an asset. If I have a partnership, or if I'm a single owner of the rental property, there's no balance sheet. But if I'm a partnership LLC or a multi-member LLC, security deposits would be reported on the balance sheet as an asset. They don't actually become realized income until you refund part of the security deposit. So let's say that you have a turnover of one of your units, and the person just absolutely destroyed the carpet and destroyed the drywall, and so you keep their full security deposit. At that point, the $2,000 security deposit becomes revenue for you, and then you offset that revenue with all of the costs that you incur for bringing the property back up into a livable situation. So, but when you collect the security deposit, that is not income. It is just considered to be an asset, and it doesn't become realized until you find out how much you're keeping out of the security deposit during turnover of the unit or the rental investment.
Great, thank you. I just know that that's one where I've seen a lot of people make that mistake, so I just wanted to throw it out there because we were waiting for some of you guys to write questions in. So if you have questions, now's the time. Lauren, okay, here we go. I came in late. What is the difference of S Corp and C Corp?
C corporations in the tax world are also known as double taxed entities, meaning that C corporations not only pay a corporate taxation amount, which currently is at 21% federal, 9.3% state, and could possibly be bumping to 28% under Biden's administration in the upcoming months. But as of now, as of today, it's still 21%. I do actually believe that the 28% rate will be passed for C corporations. But since 2018, the C corporation tax rate has been 21%. So you pay corporation tax at the C corporation level, and then whatever you pay yourself individually, you pay income tax on the personal side. So C corporations are double taxed entities. The S corporation does not have a federal income tax. It is known as a pass-through entity, so you report your income and your expenses under the S Corp, and whatever the profit is after you've paid yourself a salary, after you paid yourself office rents, after you've depreciated expenses, whatever that company profit is, it passes through to you individually, and you only pay federal income tax on the individual return. But you're reporting all of the profit from the business and what you paid yourself. So C corporations, double taxed entities. S corporations only pay income tax on the personal side. The corporations, all corporations and LLCs have miscellaneous California filing fees. So you'll still have a California Franchise Tax Board filing fee, but there will be no federal income tax for an S corporation or an LLC. LLCs and S Corps pass through their income and profit to the individual taxpayer, and you pay it one time on the individual tax filing.
All right, here we go. Jill on YouTube. Will an LLC also protect me from international owned property and business?
So that's a great question. That's more of a legal question, unfortunately. So I want to stay in my lane here. I'm an income tax professional, so I don't want to be giving legal advice on the webinar today. So you'll probably want to talk to an international tax attorney about that.
Okay. And
Or
is it
foreign
possible for an LLC to create a trust? This is Rick on YouTube.
Is it possible for I'm sorry,
An
can you repeat that one more
LLC
time?
to create a trust.
An LLC to create a trust. I believe that a trust would come before that, but it really all depends on what type of trust you're talking about. If you're talking about a living trust, the living trust would kind of be at the top part of the structuring tree, so to speak. If you're talking about a trust that's set up to hold a 401k, because there are different types of trusts, and once again, this is a whole other world, the legal side of the tax industry, that a trust attorney or an estate attorney would set up for you. But there are different types of trusts. So there's a trust that holds your retirement account, and then there's a living trust that might protect your assets from probate. So it really all depends on what type of trust you're talking about. You wouldn't want an LLC to set up your living trust, though, because at that point, the LLC would own the living trust and it wouldn't protect the LLC from probate. You'd actually want the living trust owning a majority, if not all, of the single-member LLC or multi-member LLC, so that if, heaven forbid, anything happened to you, the trust keeps that LLC and its assets from going to probate here in the state of California. So if an LLC is a trust account for a retirement account, that's a different story. So you'd actually have an LLC. No, still actually you'd have the property under the LLC, and then the LLC held in the trust, which is a 401k, and that allows you for greater asset protection as well as tax deferral of the rental property cash flow within a 401k. So I don't think that you'd ever run into a situation, at least I haven't, where an LLC would set up a trust. But once again, there might be other scenarios that I'm not thinking about, but it's not very common.
Great. Love it. All right, Sue, in a 1099-K, are gross payments received by individual, but it does not take into consideration cancellations and refunds. How do you recoup cancellations/refunds given back to the renter?
So the 1099-K is a very somewhat new document. It's only been around, I believe, for like 3-4+ years. It hasn't been around for a very long time. it should actually itemize quite a few things on that 1099K, but if it shows money that you never received, you would actually, on your tax return, on your Schedule C or on your S Corporation or LLC or C Corporation return, there's actually a box for returns and allowances. So let's say that the 1099K shows $100,000, but $20,000 of that money was never actually received, but it shows up on the transaction report on the 1099K. Well, if you only actually received 80 grand, you would put $20,000 under the returns and allowances adjustment box on the return, and it would reduce the 100 grand by 20 grand to only show $80,000 in gross reportable revenue. So there would be adjustments that are made on the tax return to make up for whatever money wasn't received but is being included in the 1099K figure.
Great. Gerald, for a simple LLC setup for a commercial property, what do you charge for setting one up beyond the standard filing fees?
So our incorporation fee, if you want to fully establish the entity with our firm, we charge $895, and that is normal processing time. I believe California hasn't reopened their expedite processes yet, so I think that it's taking about 4 to 6 weeks at the moment. If they do decide to open back up their expedited service, which gets your incorporated entity up and running in 7 to 10 business days, that's a $450 expedite charge. That doesn't go to us, that goes to the state of California. So it's $895 plus $450, so $1,345 total to have an entity up and running in 7 to 10 business days. So $895 regular processing time, $1,345 with expediting the filing.
There we go. Straightforward. One price. I like it. Lego and origami. For gifts from a foreigner to a U.S. citizen, example, Taiwanese citizen living in Taiwan gives $100K from his U.S. bank account to his kids who are U.S. citizens. Is it subject to gift tax?
So essentially, in this scenario, it depends on how many kids you're gifting to, because the annual gifting exclusion is $15,000 per individual, right? If it is money that's already paid tax and it's sitting in cash assets in a U.S. bank account, technically you can gift each child and their spouse up to 15 grand apiece. If you have 2 children, though, let's say, and they are not married, and you're trying to give them 100 grand, so 50 grand each, it would be over the $15,000 annual exclusion amount. And so, yes, you would file a gift tax return, but there is no gift tax on it. It is just simply reporting to the federal government that you are reducing your lifetime gifting exclusion by $100,000. And so, but remember that if I gift 100 grand and the lifetime or the annual gifting exclusion is 15 grand per child, 30 grand of the 100 grand does not have to reduce my lifetime gifting exclusion. It would only be the $70,000 that's left over that would be applied to reduce my lifetime gifting exclusion. A gift tax return would still need to be filed, though, in that scenario.
Great. On YouTube, no option. Is that true if LLC income is more than $250K, then LLC needs to pay higher tax? If so, how much more in percentage?
So remember that there is no tax for an LLC. It's actually something called they call it a gross receipts tax, but it's not going towards paying down any liability. So to me, I call it the gross receipts filing fee. And so under an LLC, unlike an S Corporation and a C Corporation, LLCs file a filing fee with the state of California based on their gross revenue, not their net profit. And yes, at about $249,999, your gross receipts jumps from $800 up to $1,700. And then I believe once you're above 500 grand, it jumps to $800 plus $1,700. And then it incrementally gets larger. And I believe that at about $4 or $5 million, I think it jumps to $12,000 in annual gross receipts filing fees. So an LLC doesn't have tax, so to speak. It has a gross receipts filing fee with the state of California. Most people know it as a gross receipts tax, but normally what tax does is it pays down liability, right? So like a payment towards a tax liability, it pays down the liability. This does not pay down a liability at all. It literally is a fee to the state of California because of your gross receipts being so high. So once again, in a rental property scenario, let's say that you have a shopping center that's generating 600 grand in gross receipts. but your net profit is only 20 or 30 grand. Well, California's filing fee is based on the 600,000 gross rents, not the net revenue. But there's really no way to avoid that, because you wouldn't want to put your property under a corporation, because, and I don't want to dive down a rabbit hole here, but I just want to explain really quick that if I put my, let's say, $1 million property under a corporation versus putting a $1 million property under an LLC, the day that I transfer title of that $1 million asset into a corporation, I am trading that property for $1 million in shares of a corporation. So let's say 10 or 15 years pass and I decide that I want to move that property back to my personal name, not sell it, but just take it out of the corporation. I'm done with the filing. I don't want to have it under the entity anymore. So I make a property distribution to myself. Well, over 10 or 15 years, that $1 million property might be worth $4 million now, seeing about $3 million in appreciation. Well, the federal government doesn't see it as a simple transfer of asset. They see it as a liquidation of stock under a corporation. So even though you didn't sell the property, you would see a $3 million capital gain because you're taking the property out of the corporation that was $1 million basis when you put it in. Now it's valued at $4 million. So there's a $3 million capital gain because you sold stock, but in the form of property. An LLC, you can transfer title, you can distribute title, you can transfer capital, you can distribute capital, you can put money in, take money out. You could do things under an LLC free from having a capital gain tax requirement. That's one major difference between a corporation owning real estate and an LLC owning real estate, just as a side note there. So once again, I hope that I answered that question at the beginning. I don't know if any other specifics are needed on that.
Great. Well, right now I don't see any other questions. If you have a question, go ahead and put it in there. We'll start to wrap it up. Again, 12 o'clock we do have one about storage, self-storage units, and it's kind of like peanut butter and jelly or chocolate and peanut butter. They go well together. If you can get them strategically located close to your apartments, it can be a real great way to do it, and just other ways to do self-storage, to invest in that. So you'll want to check that one out. And let's see, last week, it was a 1031 exchange. And next week we have one on mold and basically what your liabilities are and how you can remediate, plus a whole lot more. So you'll want to you got to stay in the know. There's so many little things. And so definitely, if you go to the AOA USA website, aoausa.com, at the very bottom on the right side, you can subscribe to the newsletter, whether you're a member or not. If you are a member and you're not getting the newsletters, you need to update your email address or check your spam folder, because we're sending those to you and we're trying to keep you in the know. So keep us in the know on what your address is so that you can continue to get the emails. Okay, here we do. We do have something here. We do have one question here. It looks like it's coming in. So anyway, I'll say that, and let's see if we can get a full question here. Okay, any items or suggestions or deductions? I don't know if that is a...
Is that a question, or what? What do you?
I don't know. Maybe it's a suggestion for the next live stream.
Yeah, I mean, as far as deductions are concerned, there are very few things. There's a short list of what you can't really deduct against a business, right? Everything else could potentially be a business write-off, but you have to talk with your tax advisor about how to write these other expenses off. But there's a very short list of the big no-nos, right? Your gym memberships, your personal clothing, unless it's a uniform and has branded material on it. Even though I'm required to wear a suit to work, it doesn't say Robert Hall and Associates anywhere on it. So I wouldn't be able to write this off. Not even the dry cleaning, to be real honest with you. I might take a small dry cleaning amount for special events. Wearing the suit here to AOA, I might take my dry cleaning expense from this event because it's a special event. But if I'm just required to wear a suit every day to work, it's not going to be a write-off for me. So gym memberships, personal clothing, country club memberships, as well as there was one other one that I wanted to say. Personal groceries like your milk, your lettuce, your the rice that things that you buy for your primary residence, because that's personal, that wouldn't be a tax write-off. Everything else, I'm not saying is 100% tax deductible, but everything else could potentially be a write-off to offset self-employed income and or rental income, rental investment income, continued education, legal and professional fees, travel, meals, depreciation on vehicle purchases, dues and subscriptions, licenses and permits, improvements to properties, appliances that you purchase, office furniture, desks, chairs, filing cabinets, shelving units, storage units. I mean, the list goes on. And on our website, roberthalltaxes.com, if you go to the top of the very first page, there's a tax forms button. You click that, you scroll halfway down the page, there will be examples of what would be tax deductible for you in specific industries, including real estate professionals, firefighters, law enforcement, teaching industries, just a number of a list of information and downloadable PDF documents that might help you, establish reasonable basis for some of these expenses. And a very detailed list. So.
All right, 2 more questions. Okay, set up an LLC for my property management company and then learn that California DRE does not accept this entity. Would it be better to dissolve the LLC or set up an S corporation for the property management company?
Interesting. Well, I think that you could probably simply, and once again, this is not an income tax question. This is more of like a legal question with the Department of Real Estate here in the state of California. So I think that you could probably navigate around that simply by converting the LLC into an S corporation. That might be a better question for an attorney. I know tax-wise it wouldn't matter, because tax-wise, if you're an LLC or you're taxing yourself as a subchapter S corporation, it's going to be a pass-through entity. All of the tax liability would be paid on the individual side. So I think that you probably want to talk to an attorney about that question.
All right. Self-employed individuals can deduct for home office in Schedule C, but what about an S Corp? Can we claim for any auto or home office expenses?
So under a corporation, the game changes completely. That's a great question. So you actually no longer file the in-home office form that a Schedule C filer would file. You'd actually have a contractual agreement with your corporation to pay you rent on a monthly basis out of the corporation. You'd claim it as rental income on your individual return, but then you'd allow that rental income to be offset by mortgage interest, property taxes, insurance, office improvements, office desks, chairs, filing cabinets, office equipment, and then also that great phantom expense called depreciation. So you actually wouldn't file the in-home office form anymore. You'd actually pay yourself rent, and you'd file a form Schedule E, which is a rental property form. So great question. Corporations play a much different game than sole proprietors and single-member LLCs do.
Great. Well, that's all we have today. And I know that you went into detail, I believe, about what you can and can't deduct in one of the other videos that we did. So not sure how people would. I can't remember which one that was. I don't know if you remember. If you remember that one, let us know, and we'll put a link in the bottom of this one so that people can find yet another video about you. Sound good?
Sure, absolutely. I think it's called Top Tax Deductions. That might have been one of the more recent webinars that I did here. So yeah, keep an eye out for that one. That has a list of great expenses and things to deduct.
I'll search it in right now. Let me see. Yeah, there's a bunch of them. Anyway, yeah, so not going to be able to find it real quick, but anyway, we'll see some of you at 12 o'clock, hopefully, and to learn more about self-storage, or next week for the mold remediation and liability, what you need to know. So definitely tune in, and we'll see you then. Thank you so much.